The stock market has taken a big dip in 2022. Now is the time to buy the dip. If you missed the big crash in 2020, this is your opportunity. I'm going to show you exactly how to find undervalued stocks. Hi, this is Mosh. I'm an amateur trader investor, and today we're going to look at finding undervalued stocks, quality stocks, bear in mind, and how we go about using ratios to find them. Firstly, we need to understand why a stock may become undervalued. The first thing is the changes in the market. Currently, there is a fear of recession and there's been a big sell-off at the moment. There can also be sudden bad news for particular stocks. So for example, a lot of the Chinese stocks like Alibaba, they took a big hit because of the regulations around it that the Chinese government was imposing. It can be also due to cyclical fluctuations. Markets go round in cycles. So for 2020, the whole energy sector was down. Now the energy sector is doing really well and energy companies are doing really well. So there's always a cycle that it follows. And lastly, it could be misjudged results. A company has done better or worse than what was expected by the analysts. Now, stock picking should not be based on how you feel about the company. Remember, these are companies you're investing in. So they have to be quality companies that either make money or have the potential for massive growth for you to make money in the end. For example, if you had a business, you would want to make sure that you're making profits every quarter. And as an investor, that's how you should analyze a company. That's how I do it. I do a fundamental analysis of the company. I'm going to go through 8 ratios, and every time I go through a ratio, I'm going to use a stock screener to find stocks based on that analysis. So let's start off with the most common one, which is the PE ratio. The price to earnings ratio is probably one of the most popular way to measure the value of a company. It basically shows you how much you have to spend to make $1 profit. And a low PE ratio may indicate that the stock is undervalued. The way it's calculated is price per share divided by earnings per share. And the way earnings per share is calculated is the total profit of a company divided by the number of shares issued. And I'll go through an example for each one of these ratios. Company X, its share price is $50 per share as it currently stands. Company X has 10 million shares in circulation and it makes a profit of $100 million. So the first thing we need to work out is the earnings per share, EPS. So it's going to be $100 million because that's the amount of profits made, divided by 10 million, because that's the amount of shares issued. That gives us an earning per share of $10. Now, the next thing we need to do is the current share price is $50 of company X. So $50 divided by the earnings per share, which is $10, which gives us a PE ratio of 5. So that means for every $5 you invest, you get $1 back in profit. And that would be a very good value because assuming the company makes the same amount of profit every year, you'd recoup your investment back in 5 years. So what we can do now is we can go on Finviz and go to a screener. It's free to use. And you can see there's loads of different things that you can screen for, but we're going to do fundamental analysis and we're doing PE ratio. So it's right here. And I would say PE ratio under 5 is very good. So if we put it in, it gives us 471 companies. And just to make it a little bit easier so I don't get any unknown companies as such, I'm going to put any company over the value of 2 billion. So market cap over 2 billion. So it gives us 96 companies that have a PE ratio of under 5. And if I just screen it by market cap, wonder if any of the big leaders, oh wow, Rio Tinto is on there. It's a massive one of the biggest mining companies in the world. You got Moderna in there, you got Ford Motor Group in there. So some really good companies with very low PE ratios. And something like Ford, if we compare it to Tesla, Tesla has a PE ratio of over 100. The next ratio that's an important one is a debt to equity ratio, also known as a DE ratio. This ratio compares a company's debts to its assets. An asset is anything the company owns that is of value. A higher ratio means the company gets a lot of its money from lenders and not its shareholders. However, that doesn't necessarily mean it's undervalued, because what you have to take into account for this one is what industry the company is in, because some industries are known to live off loans. It's just how the industry is. whereas other companies or other industries, not so much. So you always have to compare that company to its major competitors. Now, the DE ratio is calculated by dividing its liabilities, so things that it owns to other people or banks or loans, whatever it has, by the shareholder equity. And I'll go for an example. So company X has 1 billion in debt, so in its liabilities, and a shareholder equity of $500 million. So in this example, we'll do $1 billion divided by $500 million, and that will give us a DE ratio of 2. That means for every $2 of debt, there is $1 of equity. Now, if we go back to Finviz, and they've got here a long-term debt to equity ratio. Now, for me, I always like finding companies that have assets worth more than the debt. So for example, if your house is worth $100,000, the bank is very unlikely to give you $200,000, because if something goes wrong, you can't pay the money back. They can only recoup the value of your asset, which is $100,000. I like having the DE ratio of under 1. So I want the company to have more assets than it has debts, or the value of the assets, I should say. All right, so you can see still at the top, based on market cap, is Rio Tinto Group, China Petroleum, Chemical Corporation, Moderna, BioNTech, Liberty Global. So there's a lot of companies still. There's 62 companies that meet this criteria that I put in at the moment. And make sure you keep watching to the end to find out which companies are undervalued using all these 8 metrics. Number 3 is return on equity. So return of equity, or ROE, is a percentage that measures the company's profitability against its equity. So the ROE is calculated by dividing net income by shareholder equity. So for example, a higher ROE could mean that the shares are undervalued, because the company is generating a lot of income, a lot of money, relative to the amount that the shareholders are put in. And I'll go for an example to make this nice and easy. So let's say company X has a net income, which is minus the liabilities, minus any debt, of $90 million. It has a shareholder equity of $500 million. Therefore, the ROE is going to be $90 million divided by $500 million, which gives us 18%, which is not bad. So if we go to Finviz, and you can see here, there's a return on equity box, and I want it, well, let's go for very positive. So more than 30%, which is very high. Okay, wow. So again, Rio Tinto is still up there. That might be one that I might just put some money in. It's looking very, very good. BioNTech, Macy's in there as well. That might be a decent one, actually. That's sort of piqued my interest. And you can see there's 35 companies on this list. Okay, number 4 is the earnings yield. It's basically the PE ratio in reverse. Instead of being price per share divided by the earnings per share, it is the earning per share divided by the price per share. Now, some investors like using this because if the earning yield is higher than the average US Treasury bond, and we can see what it is, so US government debt, that gives you a yield of 3.22%. And if you're getting a earnings yield higher than that, normally it's a good investment. So let's go for an example. Company X has an EPS of $10 and its share price currently is $50. So that means if we do $10 divided by $50, it will give us an earnings yield of 20%. That is much higher than the US 10-year Treasury bond, which is 3.22%. So that would seem like a good investment. Number 5 is the classic dividend yield. So this is how much portion of a company's profit you get as a shareholder. And it's nice and easy to do. It's the dividend per share divided by the current price per share. That will tell you a dividend yield. And dividend yields tell you that the company is stable, it's generating money, income, some profit. So it reduces that risk as well because you're getting some money back from your investment. And I'll do a quick example of dividend yield. So for example, company X pays out a dividend $5 per share. The current share price is $50. So if we do 5 divided by 50, that's going to give us a dividend yield of 10%. In Finviz, they don't actually have an option for the yields. You'll have to go into individual companies and find the dividend yield and the earnings yield. But we're going to put in the other ratios that are left over. So number 6 is the current ratio. For me, this is an important one. The current ratio is the ability of company to pay off its debt. And it's calculated by simply dividing the assets by its liabilities. And liabilities is all the debt it has. Now, if a company has a current ratio less than 1, it doesn't have enough assets to cover its debts. So for me, that would be a bad thing. However, that could potentially lead to an undervalued stock because investors might be worried about that company and sold off a lot of the stock. So for example, if company X has $1.2 billion in assets and $1 billion in liabilities, which is known as debt. So the current ratio is going to be 1.2 billion divided by 1 billion gives us a current ratio of 1.2. So if I go to Finviz, I don't like companies having too much debt. Because remember, you want to generate money, generate profit. And it's like a person, someone that has too much debt, they're almost drowning. They're making money just to pay off the debt. So I like having a current ratio less than 1, a low current ratio. So as you can see, it's only come up with 2 companies, the energy companies. Now I want more of an option. So I'm just going to leave this on any. Okay, so it gives us more of options, 35 companies. Otherwise, we've really limited ourselves. Number 7 is the price to earnings growth ratio, also known as a PEG ratio. So the PEG ratio looks at the PE ratio compared to the percentage growth in annual earnings per share. So if a company had a solid earnings but a low PEG ratio, it could mean that the stock is undervalued. And to calculate the PEG ratio, all we have to do is divide the PE ratio by the percentage growth in annual EPS, earnings per share. So let's go for an example. Company X has a PE ratio of 5. And remember, that's just the price per share divided by the EPS. And it has an annual growth rate of 20%. So the PEG ratio is going to be 5 divided by 20% gives us 0.25. Now, if we go to PEG ratio and try and do it over 1, it's going to again limit our options. So we got steel and lumber wood production companies. One's in Luxembourg, one's in USA. To be honest, this steel company looks very, very good. It has a very low PE ratio, decent market cap and nice volume. But what I'm going to do, I'm going to leave this on any, so it gives us a little bit more options when we're looking at our companies. The last one is price to book ratio or PB ratio. Now the PB ratio is used to assess the current market price against the company's book value. Book value is its assets minus any liabilities divided by the number of shares issued. So to calculate it, we divide the current share price by the book value per share. And we consider a stock undervalued if its PB ratio is less than 1. So for example, company X current share price is $50 and it has a book value of $70, which means the PB ratio is $50 divided by 70 gives us 0.71. So if I go to Finviz and let's say, let's see how many companies it gives us if we put less than 1. Okay, so it's given us a list of 8 companies. Now you can see steel, lumber, wood, steel, oil and gas, utilities, and generally the energy companies that seem to be on this list. I'm just going to move it to under 2. Okay, so it gives us a list of 29. Now, just quickly filtering through this list, Rio Tinto, I think that seems quite appealing to me. So that's one I might invest in. I'm not a big fan of medical companies, just generally, it's just how I am. But if you're interested in that, Macy's again, it's a consumer cyclical. It seems like a decent one, especially with inflation running so high. And let's go to the second page. All right, these companies I'm not sure of, but it's things that I can definitely look into, especially this marine shipping in Greece. That could be a very good buy, and it has a very low P ratio of 3.05. And remember, all these, the PB ratio is under 2, the long-term debt to equity is under 1, so they don't have a lot of debt. And the return on equity, so they make decent money, these companies. I hope you enjoyed this video. And remember, there's loads of different ways to find undervalued stocks. Or you may just feel like it's an undervalued stock, but always go back to the fundamentals. Because at the end of the day, that is what matters. I'll appreciate a like and a sub. See you next time.